Tēnā koutou katoa, the Cashmere High School Monetary Policy Committee has decided to lower the official cash rate by 0.25 points to 1.5%. Both domestic and global economic growth is weakening, which will likely dampen inflation, already well below the target midpoint at 1.5%. Although employment is near its maximum sustainable level, there have been signs of a slowdown in the labour market. Due to these three key deflationary pressures, we've decided that a lower OCR was necessary to stimulate the economy in order to fulfil the Reserve Bank's mandates for employment and inflation. The committee also recognised that there are various uncertainties that may require a further decrease in the OCR in the near future. We'll now discuss our analysis of key economic indicators in more detail. Inflation decreased from 1.9% in December 2018 to 1.5% as of March 2019, under the 2% midpoint of the target range. This low inflation suggests a decrease in the OCR is necessary to ensure inflation remains within the target band of 1 to 3%. In the short term, domestic GDP growth is set to pick up, having increased by 0.6% in the December 2018 quarter. However, the long-term outlook is for a moderated slowdown in growth, with a 0.9% increase in GDP per capita in 2018 being the lowest figure in 8 years. This weak growth outlook indicates that a decrease in the OCR would be prudent in order to stimulate the economy. Consumer confidence was at a below average level in the March 2019 quarter, and business confidence is at its lowest level. Consumer spending did increase despite this by 2.7% over 2018, although businesses are reporting a decline in profitability, which will likely impact employment demand and investment activity throughout 2019. The Labour government's stimulatory fiscal policy is a source of inflationary pressure, as core crown expenses increased to 29.5% of GDP in 2019 and are expected to stay around this range until 2022.
The unemployment rate fell to 4.2% in the March quarter, meaning employment is near its maximum sustainable level. However, employment growth also decreased by 0.2% due to a fall in the participation rate. This indicates a slowdown in the labour market, suggesting that a decrease in the OCR is necessary to encourage more economic activity. Tourist arrivals for last year rose 4% and are set to increase 4.6% yearly until 2024. This increases tourist expenditure, contributing to demand pull inflation. Net migration is declining from its 2016 peak and is expected to continue falling. This will slow population and employment growth, decreasing inflation.
House prices have continued to increase, with the median price in the March 2019 quarter being 4.5% higher than the March 2018 quarter. However, during this time period, there's been a 12.9% decrease in the quantity of houses sold. With mortgage rates remaining low, this suggests that house prices are likely to continue to rise, but at a more subdued rate than what was seen before. Current mortgage rates are at a historical low, however, we expect them to increase as LVR restrictions are relaxed. This could lead to deflationary pressure.
As you can see in the table, uncertainty around Brexit has created volatility in the UK's economy. The USA is experiencing strong growth, with GDP in 2019 up 1% from last year. Australia's unemployment has increased to 5%, and they have also seen decreased growth. The slowdown of economic growth in key trading partners is a source of deflationary pressure in the New Zealand economy.
In March this year, there was a current account surplus of $922 million, which was significantly higher than expected. This current account surplus reflects an increase in aggregate demand, resulting in an inflationary pressure. The trade-weighted index has remained around projections of 73 over the last quarter. As other countries are decreasing policy rates, if New Zealand does not follow, this could lead to an appreciation of the New Zealand dollar, which would be detrimental to the exporters and New Zealand's current account. Trade wars fell 1.3% in the March quarter, driven by low petrol and airfare prices. Non-tradables rose 1.1% in this quarter, driven by rising prices for tobacco and rentals. This results in slight deflationary pressure.
Our analysis has identified that deflationary pressures currently exceed inflationary pressures in the New Zealand economy. Thus, a decrease in the OCR to 1.5% is imperative in order to encourage more economic activity and ensure inflation and employment are at levels in accordance with the stipulations laid out in the Policy Targets Agreement. Thank you for your time.